When you leave a job, you usually have 5 options for your old 401k. You can roll it into a traditional IRA, roll it into your next employer's 401k, leave it at your old employer's 401k, convert it to a Roth IRA, or cash it out. In this video, I'll walk through each option, explain the pros and cons, and help you figure out which one actually makes sense for your situation. So let's jump right in. Option number 1, roll it into a traditional IRA. This is one of the most popular options, and honestly the one I'd recommend to most people. When you roll an old 401k into a traditional IRA, you're able to keep the tax-deferred status of your retirement money while usually upgrading your investment choices and lowering your fees all at the same time. That's a triple win in my book. You can do this by opening a traditional IRA at a brokerage firm like Fidelity or Charles Schwab and rolling your old 401k directly into it. Once the money's there, you're in the driver's seat. You have full control over the account, access to a much wider range of investments like individual stocks, ETFs, and bonds, and in many cases, you'll pay significantly lower fees than you would inside an employer-sponsored plan. Now here's my pro tip. When doing a rollover, start by contacting the receiving brokerage company, not your old 401k provider. They're the ones getting your money, so they're usually more helpful. When I evaluate retirement plans, I focus on 2 main things: fees and investment choices. The fees to look out for include investment fees, also known as expense ratios within the funds, administrative fees, which are often charged by the provider quarterly or annually, and then individual service fees for specific things like loans or withdrawals. In terms of investment choices, I really just look for 3 specific funds: S&P 500 Index Fund, International Equities Index Fund, and a total bond market index fund. Honorable mention if they have target date retirement fund options. Option 2, roll it into your new employer's 401k. Another option is rolling over your old 401k into your new employer's 401k plan. In simple terms, you're consolidating accounts so everything lives in one place. For a lot of people, that simplicity alone is a huge win. Only one account, one login, and one statement to keep track of. This option can be especially appealing if you plan on doing a backdoor Roth IRA in the future. By keeping your money inside a 401k instead of an IRA, you help keep your IRA balance a little bit cleaner, which avoids running into the pro rata rule for Roth conversions. There's also a really important planning advantage later in life. If you're still working at age 73, rolling your old 401k into your current employer's plan can allow you to delay required minimum distributions or RMDs until you actually retire. That can mean more years of tax-deferred growth and more control over when you withdraw funds in retirement. Now, this option does have some drawbacks. Not every employer plan allows incoming rollovers, so you'll need to check with your plan first. And even if rollovers are allowed, some 401k plans have high fees or a limited menu of investment choices compared to what you'd get inside an IRA. Overall, this is a solid option if your new employer's plan is high quality, offers low fees, and good investment options, and you really value the simplicity of consolidating 401k accounts. Option number 3 is simply leaving your money right where it is, in your old employer's 401k. This is by far the easiest option because in most cases, if your balance is over $5,000, your former employer is required to let you keep the account open. Some people may choose this option if the investment options are already solid, the fees are low, and they just don't want to deal with rollovers right now. And honestly, that makes sense. If it ain't broke, don't fix it. There are a few advantages here. You don't have to take any action at all, your money continues to grow tax deferred, and your 401k often comes with stronger legal protection from creditors compared to IRAs. But there are some meaningful downsides to be aware of. Because the account is tied to a job you no longer have, it's easy for it to get forgotten or neglected over time. And if your old employer changes plan providers or administrators, what was once a do-nothing option can quickly turn into a huge headache. So here's the bottom line. Leaving your money in an old 401k can be perfectly fine for a short-term solution, especially if the plan is good and you're in between jobs. But for most people, it's not a great long-term strategy, and eventually it makes sense to consolidate and take more control. Option number 4 is converting your old 401k into a Roth IRA. For this option, you're voluntarily paying income taxes today in exchange for future tax-free growth. Here's exactly how it works. When you convert money from a traditional 401k or IRA into a Roth IRA, That converted amount is treated like taxable income in the year you do the conversion. So yes, this does trigger a taxable event. But once the money is inside the Roth IRA, all that future growth and qualified withdrawals are completely tax-free. That's a big upside. A Roth IRA gives you tax-free growth, no required minimum distributions during your lifetime, and a lot more flexibility in retirement when it comes to managing your taxes. The biggest downside is just timing. As I mentioned before, you owe ordinary income tax on every dollar you convert in the year of the conversion. This isn't something you want to do without proper tax planning, so I'd recommend consulting with a tax professional. But this option could make sense if you believe your current marginal tax rate is lower than your future marginal tax rate in retirement. Option number 5 is to cash out your 401k. And I'll be honest, I would only recommend this as a last resort in an emergency. When you cash out a 401k before age 59 and a half, the IRS takes a huge chunk out of it. You're hit with a 10% early withdrawal penalty, and you owe federal and state income taxes as well. But the real damage goes beyond just the taxes and penalties. Not only are you losing money to that, but you're also giving up the opportunity cost of future potential compound growth. There are situations where this might be unavoidable, but outside of a genuine financial emergency, I would say cashing out a 401k should be a last resort. Here's a quick summary of what to do with the 401k from your old job. Do you want the best investment options at the lowest cost? Then you should roll it into a traditional IRA. Do you want to keep it in a 401k? Then you should pick between leaving it in your old plan or consolidating it with your new plan. Or do you want future tax-free growth? Then you should consider a Roth conversion. Your 401k is likely one of your biggest assets, so don't be shy about rolling it over based on which option suits you best. If you found this video deserving, please hit that like button and subscribe to the channel for more personal finance content. What do you do with your old retirement accounts? Do you consolidate them or let them sit? Drop a comment down below and I'll see you in the next video. Take care.